Hi, my name is Denise and my teammates are Yelani and Esther, and this is our market view presentation on the two currency pairs, the Australian dollar and the Japanese yen, and the Australian dollar and the US dollar. The Australian dollar is the fifth most traded currency in the foreign exchange market. It became a floating exchange rate in 1983, which is a type of regime where the currency price is set by the foreign exchange market based on supply and demand compared with other currencies. The Japanese yen is the third most traded currency in the foreign exchange market, following behind the US dollar and the euro. It is also widely used as a reserve currency after the US dollar, euro, and British pound. Japan switched to a floating currency in the year 1973. According to the Department of Foreign Affairs and Trade, between 2015 and 2016, Japan was Australia's third largest trading partner, leading the exchange rate between Japan and Australia to be a very important factor for attaining economic growth. Japan has a strong industrial base. It is home to some of the biggest and most technologically advanced manufacturers of cars, electronics, and machinery. The relationship between Australia and Japan is crucial, seeing as Australia is a critical supplier to Japan for raw materials, minerals, and energy so they can manufacture their goods and services. The graph outlines the relationship between the Australian dollar and the Japanese yen. From this graph, we can see that the Japanese yen fluctuates very often. For the past 2 years, the yen has been decreasing against the Australian dollar. As of 2017, the yen sits at 90.2 for every Australian dollar, the highest it has been since December 2015. According to the Reserve Bank of Australia, the inflation rate of Australia as of June 2017 is 1.9%. From the graph above, we can see that Australia's inflation rate has been steadily decreasing since 2010. The Japanese inflation rate as of July 2017 is 0.4%. As we can see from the graph above, Japan's inflation rate decreases faster against Australia's inflation rate. If this pattern continues, then we can see the Japanese yen appreciate against the Australian dollar. The inflation rate for Japan is currently lower, meaning that there is a higher demand for Japanese exports and a higher demand for the Japanese yen to purchase Japanese goods. A higher interest rate encourages more overseas investors to invest in the country's financial market because it results in a higher return. This decreases the supply of the currency and increases its demand, resulting in an increase in the value of the currency. According to the Reserve Bank of Australia, Australia's cash rate is currently at 1.5% and has been unchanged since August 2016. Seeing as Australia's cash rate has been decreasing since 2011, this could potentially deter investors away. Japan's cash rate is currently sitting at negative 0.1%. A negative cash rate means that when money is deposited, this attracts a fee. It is costly for banks to maintain a negative cash rate, seeing as they do not earn money from interest payments, but rather they have to pay borrowers interest. This discourages local Japanese people from investing in their country's financial market, therefore looking to invest into markets overseas for a higher return. This will decrease the demand for the Japanese yen and increase the supply, causing a depreciation of the currency. When comparing the cash rate of Japan against the cash rate of Australia, it is clear that investors would rather choose to invest in Australia over Japan because their higher cash rate would incur a higher return. This would result in a higher demand of the Australian dollar and a decrease in the supply, which results in an appreciation of the Australian currency. Australia has a small domestic industrial base, therefore its economy strongly depends on various commodities, for example, exports of iron ore to China. The demand for commodities and commodity prices in Australia are directly proportional, therefore a decrease in demand for Australian commodities will in turn decrease the value of the Australian currency. Japan is ranked as the third largest automobile manufacturing country after China and the United States. 90% of its exports are domestic industrial based, and its commodities are mainly secondary products like laptops and houses. Japan relies on economies such as Australia for the imports of raw materials to manufacture these secondary products. From the graph, It shows that during mid-2008, the rate of commodity prices and interest rate differential between Australia and foreign countries has fallen. As the Australian dollar is essentially a commodity currency, the decrease in commodity prices will weigh down Australia's exports value and therefore causing a depreciation in the Australian dollar. However, the depreciation of the Australian dollar leads to an appreciation of the Japanese yen, as Japan does not need commodities to stimulate exports. Seeing as Japan currently has a lower inflation rate, foreign investors and consumers will want to purchase more goods and services from Japan rather than Australia because of the relatively lower prices. This will increase the value of the Japanese yen over the Australian dollar. As commodity prices continue to fall, if they keep decreasing across the next 3 to 6 months, we can expect the Australian dollar to depreciate against the Japanese yen. Although the Japanese rely on Australia for exports of raw materials to manufacture their goods, as the Australian dollar depreciates, the yen will appreciate because they can still source their raw materials from other international markets. The US dollar is one of the most widely used currencies across the globe. It is used both as an official currency and for international trade outside of US borders. The US is Australia's largest two-way investment partner and by far the second largest investor in the Australian market after China. The Australian dollar has increased by 4.1% in July, trading at above 80 US cents for the first time in 2 years. It has remained at 80 US cents as of September 2017. The Australian inflation rate sits at 1.9%. The US inflation rate currently sits at 1.98%. While inflation rates in Australia have been steadily decreasing, we can see from the graph that the US inflation rate is fairly volatile. They experienced an increase in inflation during 2016, which dropped towards the end into 2017. As Australia has a lower inflation rate than its trading partner, they will experience more demand for exports. This means the US dollar will begin to depreciate against the Australian dollar. Australian exports will become more inexpensive and therefore increase its demand. While Australia's cash rate is currently 1.5%, the US cash rate sits at 1.25%. The US cash rate has always been lower than that of Australia's, but has been steadily increasing since October 2016. When we compare the cash rate of the US against Australia's, although the US has increased, investors would still opt for the higher interest rate return, therefore choosing to invest in the Australian financial market instead of the US's. This indicates a higher demand for the Australian dollar, which would result in an appreciation of the currency. However, when looking at the political atmosphere of the US, this could also have an effect on the Australian dollar and the US dollar. The Trump administration has plans for a 4% economic growth accompanied by tax cuts and infrastructure spending. The US has a goal of reaching 2% for its interest rate. If these changes are implemented, the US dollar will most likely appreciate and the Australian dollar will depreciate. The policy changes are made to encourage capital inflow, increasing demand for the US dollar. However, the main impact will be a weaker Australian dollar. The US is the second largest exporter in the world. They shipped $1.454 trillion worth of goods internationally in 2016. Some of the US's top exports are machinery, aircraft, vehicles, and mineral fuels, including oil. According to CNBC, the US has had a continuous price drop in oil in the last 5 months. The price of copper has also declined in 2016, according to David Wessel, director of the Hutchins Center on Fiscal and Monetary Policy at the Brookings Institution. If the prices of US commodities continue to drop, we will see a depreciation in the US dollar against the Australian dollar because the US need these raw materials to build their vehicles and machinery, which account for a vast majority of their exports. As stated above, the Australian economy relies heavily on its commodity prices. According to an ABC News article written by Michael Jander, during September 2017, Australia has seen their commodity prices drop, including a 10% fall in iron ore spot prices. However, commodity prices in Australia are still higher than that of the US, meaning that Australia have the opportunity to import raw materials from the US for cheaper prices compared to purchasing them domestically. As demand increases from foreign countries due to the lower prices for commodities in the US, we may see an appreciation in the US dollar. Standing as of this moment, however, Australia currently has a higher interest rate and lower inflation rate than that of the US and higher commodity prices. Due to these factors, we forecast that within the next 3 to 6 months there will be an appreciation in the Australian dollar against the US dollar. However, this may be short-lived for the Australian dollar due to factors including commodity prices to continually decline and Donald Trump's presidency. In this event, the Australian dollar will drop and we'll see the US dollar appreciate against the Australian dollar again. Thank you for listening to our presentation. We hope you enjoyed it.